All right, let's jump right into it. In a financial landscape often clouded with uncertainty, one company is not just navigating, but really thriving. We're seeing a significant turn towards profitability. So today we're unpacking Affirm's latest earnings results and their forward guidance. It's, well, quite a story of resilience. We're focused on Affirm's fourth quarter fiscal year 2025 results. And this isn't just about growth, it's about a really pivotal shift, hitting profitability when, frankly, many doubted it. So what are the headline numbers that really capture this turnaround for you?
Yeah, it's quite something, truly. If you look at the top line performance, gross merchandise volume, GMV, hit $10.4 billion. That's a powerful 43% jump year over year.
Wow, 43%.
Exactly. And
Yeah.
total revenue climbed 33% to $876 million. Then there's revenue less transaction costs, RLTC. That grew 37% to $425 million.
Sure.
But the real kicker, the aha moment, is their net income, a gain of $69 million. I mean, think of it. That's a huge swing from a $45.1 million loss same time last year.
That is dramatic.
And it gets better.
Yeah.
On a GAAP basis, operating income was positive, $58 million. That gives them a 7% operating margin, just an incredible 18 percentage point improvement from that $73 million loss in FQ4 24.
Those numbers are definitely striking. And you mentioned that aha moment. It really feels like one. I mean, not long ago, people were seriously questioning if a firm could even handle rising interest rates, let alone turn a profit. So what does hitting this upgrading income profitability target, and right on schedule too, tell us about their model and discipline?
It speaks volumes, especially, given the whole macro environment. The debate was pretty intense. Could buy now, pay later even work with higher rates? And this isn't just like cutting a few costs here and there. It really feels like a validation of their long-term strategy, their focus on unit economics.
Right, the unit economics, how much they make per transaction, basically.
Exactly. And the fact that RLTC, how much they keep after those direct transaction costs, came in at 4.1% of GMV. Well, that actually beat their long-term target range. Even though it was slightly down year over year, it still highlights how efficient they're becoming. It tells you each piece of the business is proving more profitable than maybe folks expected.
Okay, so it's not just growing the top line, it's getting more efficient underneath, but how did they manage that, especially when funding was supposed to get, more expensive?
Well, that's a great point. They actually had a pretty significant tailwind from lower funding costs. Their average annualized cost of funds dropped about 90 basis points year over year.
90 basis points.
Yeah, and about 30 basis points just from the previous quarter. It landed at 6.8%. Getting that kind of reduction when many expected costs to stay high, well, it suggests really strong execution in how they secure capital and manage their balance sheet.
That makes sense. Cheaper money flows right to the bottom line.
The fact.
Okay, that's truly impressive on the cost side. Now, beyond these big financial numbers, what's actually driving the performance? Because, for anyone watching Affirm, it's the health of the network that matters too. What's fueling this comeback operationally?
Exactly right. This isn't just some financial engineering. It's built on really solid growth across their whole ecosystem. Take active consumers, for example. Excluding a discontinued business, Returnly, they grew 24% year over year,
Okay.
reaching 23 million active consumers. And what's really compelling is this is the 6th straight quarter they've seen accelerating growth in that number.
Sixth consecutive quarter, that's not a blip, that's momentum.
It really is. And it's mirrored on the merchant side. Active merchants also up 24%, hitting 377,000. So they're adding users and places for those users to spend.
That's a powerful combination, consumers and merchants growing together. But are there specific products or strategies that are really, punching above their weight right now?
Oh, absolutely. One clear standout is the Affirm Card. Its GMV grew, get this, 132% to $1.2 billion.
No.
And the number of active cardholders nearly doubled to 97% growth, hitting 2.3 million. The card attach rate, basically how many active consumers use the card, ticked up to 10%. But here's maybe the most telling part. In-store card spend specifically jumped 187%.
187% in store. So they're really breaking into physical retail then.
Definitely. It's not just an online thing anymore. The card's becoming a much more tangible, everyday tool for people. But maybe the real strategic linchpin and a huge driver recently is their 0% APR offers. GMV from those grew 93% year over year.
93%, okay.
Yeah, and it now makes up 29% of their total GMV. That's up from 25% last year.
That's a massive chunk. But wait, how does Affirm make money offering 0% APR? Especially with funding costs, even if they are lower now. It sounds almost too good for the consumer.
Well, that's the clever part of their model. The crucial thing is nearly 95% of that 0% APR GMV from their integrated merchants is actually funded by the merchants themselves.
Ah, okay, so it's not Affirm taking the hit.
Not usually, no. The merchant sees the value. For you, the consumer, it's what they call true zero transparency. No hidden fees, no tricky interest, just clear payments. And for merchants, it's a powerful sales tool. They see, on average, over a 20% lift in GMV when they offer it. So they're willing to fund it because it brings in more business, bigger baskets.
Right, it pays for itself from the merchant's perspective.
Exactly. And what's really smart is how it works for customer acquisition. About half of Affirm's new users come in through one of these transparent merchant-funded 0% deals. And here's where it connects back to credit quality. These 0% APR users. Their average FICO score is about 40 points higher than the average Affirm borrower.
Oh, interesting.
Yeah, so that translates directly into lower credit risk. Their allowance rates, the money set aside for potential losses, are roughly 60% lower for these loans compared to the interest-bearing ones.
So it's a win-win. They get growth, attract lower-risk customers, and the merchant funds it. That is a neat cycle.
It really is.
Okay, speaking of risk and portfolio health then, with all this growth, how is the quality of their loan book looking? Are we seeing any stress signs, or is credit holding up okay?
Yeah, that's always the question with rapid growth, isn't it? But the good news here is that credit quality actually looks pretty robust. Their 30-plus day delinquency rates, excluding Peloton and the PayNX loans, they actually declined.
Declined, even with the growth.
Yep, down 15 basis points from the last quarter and 18 basis points from last year. That suggests their risk management is holding up well. And if you look at net charge-offs, the loans they actually write off, recent monthly installment cohorts are tracking towards about 3.5% ultimate net charge-offs. That's pretty consistent for them. And their popular pay-in-4 loans, those are tracking to less than 1% loss rates. But yeah, despite the expansion, the controls seem tight.
Okay, those are definitely reassuring numbers for the overall health. And, of course, to support all this activity, they need a strong financial base. What's the latest on their capital position? Are they well funded?
Oh, very much so. Their capital position looks really strong. Funding capacity is up significantly, now $26.1 billion compared to $23.3 billion last quarter.
And what does that mean in practical terms?
Well, to put it in perspective, that capacity could support over $60 billion in annual GMV. That's way more than they're doing right now. Plus, they have $2.2 billion in total liquidity, which is up year over year. That gives them a healthy net cash position of $1.1 billion, also up nicely. They even have authorization to repurchase $200 million of convertible notes, with most of that still available. It just signals confidence and flexibility.
Yeah.
All in all, it paints a picture of a company with plenty of resources for future growth.
That's a really comprehensive look at where Affirm is right now. But, the big question is always, what's next? Let's turn to their forward guidance. What's the outlook look like?
Right, the outlook. It definitely reflects a continued path of strong growth and profitability. For the next quarter, fiscal Q1 2026, they're projecting GMV between $10.1 and $10.4 billion. Revenue is expected between $855 and $885 million. RLTC, $405 to $420 million. And they're guiding to an adjusted operating margin of 23 to 25%.
And for the full year, fiscal 2026.
Looking further out, the full year fiscal 2026 outlook builds on that. They're forecasting GMV of more than $46 billion.
More than $46 billion. Wow.
With revenue as a percent of GMV around 8.4%. RLTC is a percent of GMV around 4.0%. And they're targeting an adjusted operating margin of more than 26.1%. And importantly, on a GAAP basis, they're projecting an operating margin of more than 6.0%. So these aren't just, small steps. They're committing to sustained, growing profitability.
Those are definitely some bold projections. What are the key assumptions behind that optimism? What are they betting on to hit those kinds of numbers?
Well, there are a few critical factors baked in. They expect that 0% APR GMV mix to keep increasing. Now, that might slightly lower RLTC as a percentage of GMV, but the sheer volume and the higher quality customer base it brings makes it a net positive overall.
Makes sense.
They're also factoring in a modest decline in short-term interest rates. That would obviously help their funding costs even more. And there's also a technical factor, a decrease in enterprise warrant expense, which is a non-cash accounting thing, that'll help their GAAP profitability.
So leveraging their core strengths, expecting some help from rates. But they've also talked quite a bit about technology, especially AI. What role does generative AI play in their strategy moving forward?
Yeah, this is where it gets, I think, really intriguing. They're leaning heavily into generative AI, not just for internal efficiency, though they are aiming to do more with the same number of people, which is interesting.
Uh-huh.
But they see it as more fundamental. They believe AI is sort of unbundling traditional e-commerce. Think about AI agents guiding you through shopping decisions online.
Right, like a personal shopper bot.
Exactly. And in that future, Affirm sees its composable elements, basically their flexible, transparent financing options, becoming super valuable. The real insight, I think, is how they're positioning themselves. If an AI recommends a product, Affirm's simple, clear 0% offer could become the default easy payment method presented right there by the AI.
Ah, so the AI becomes a distribution channel.
A massive, potentially very trustworthy distribution channel. It flips the model. It's less about just integrating AI tools and more about making their core value, prop, that financial transparency, a key advantage in an AI-driven world.
That is a really forward-looking take. It definitely raises a big question for the future, doesn't it? As AI reshapes how we shop, how financial products get surfaced, will that kind of transparency, like Affirm's True Zero, become the key competitive edge in lending? Definitely something for you to mull over as you navigate this rapidly changing landscape. We've certainly had a deep dive today.